Welcome back to Talk Tickers. This is the deep dive where we strip away the corporate PR spin and get right down to the raw numbers that really move the needle.
We're here to find that signal in all the noise of earnings season.
Exactly. I'm your host, ready to break down the balance sheet.
And I'm here to connect those numbers to the bigger picture, the strategy, and, the whole market landscape. And today we are looking at a company that is, it's essentially fighting a trench war on one side of the building while throwing a massive party on the other.
A tale of two cities is right. Or maybe a tale of two different business models under one roof. Today's ticker is CMCSA.
Comcast Corporation.
Yep. They just dropped their Q4 2025 results. And if you're an investor, this report was a real roller coaster. It was confusing, it was clarifying, and frankly, it was a little bit terrifying in some parts.
It really was. You had the legacy cable business hitting what management politely calls an inflection point.
Which is code for we are bleeding customers.
It is. But then on the other hand, you have this absolute beast of a cash generation engine that just seems, immune to the gravity that's affecting everyone else.
I'm calling it the cash machine versus the churn. And look, if you were watching the charts on Saturday, you probably got whiplash. The stock was down nearly 3% in pre-market.
Yeah.
Total panic mode. And then it completely reversed course to close up nearly 3% at $29.24. I mean, that is a massive intraday swing for a company this big.
And that tells you everything you need to know, right? The panic was the knee-jerk reaction to the headline. Broadband subscribers are leaving. That's the trench war.
Right.
But the recovery, that happened because the smart money started digging into the cash flow statement. They realized that even while the ship's taking on water in the living room, the engine room is printing money faster than they can spend it.
Okay, let's start right there, in the engine room. Because while everyone was doom scrolling about subscriber losses, the financial results told a very different story. The headline numbers were a mixed bag, but one stood out. Adjusted EPS came in at 0.84 cents.
Which was a solid beat. Consensus was looking for about 75 cents, so they beat by, 12%? That's just efficient management.
But the revenue was basically flat, $32.31 billion, up just 1.2% year over year, a slight miss. So we're not seeing some top-line explosion here.
No, and you really shouldn't expect to, but here is the signal, the thing that drowned out the noise and caused that rally. Free cash flow.
Yes. The
street was expecting somewhere around $2.23 billion for the quarter. Comcast delivered $4.37 billion.
They nearly doubled the expectation. That is just absurd.
It's the key takeaway for this entire deep dive. In a market where interest rates are what they are and growth is scarce, cash is king. That $4.3 billion number tells investors that this company has an incredible amount of liquidity.
It means they can fund the turnaround.
Fund the turnaround, pay the dividend, buy back stock, build massive theme parks, all without having to go to the bond market and beg for money. It buys them time.
It buys them a runway. But we have to talk about why they need that runway. We have to address the ouch metric that scared everyone. Broadband net losses were 181,000.
And that's the erosion. That's the core business. I mean, for 20 years, cable broadband was the ultimate utility. You had to have it. They could raise the price every single year. You had no choice. That era it's officially dead.
So who are they losing to?
Fiber overbuilders, for one. They offer faster upload speeds, but maybe more importantly, they're losing the price-sensitive customers to fixed wireless access, those 5G home internet boxes from T-Mobile and Verizon.
Okay, so this leads us to the strategy shift. This was the first earnings call for Steve Croney, the new CEO of Connectivity. And the vibe was just different.
It was. Usually these calls are full of executives blaming the weather or seasonality. Croney didn't do that.
No, he was refreshingly blunt. He looked the problem right in the eye. He admitted the competition is intense and that the old playbook of just raising prices on loyal customers to hit a quarterly target, that's broken.
He's challenging these long-held assumptions of the whole industry.
And his solution seems to be radical simplification. I was reading about this 5-year price guarantee. That feels, almost revolutionary for a cable company.
It is. Think about the traditional cable experience. You sign up for a promo, say $50, and then year 2 it explodes to $80, and you have to spend an hour on the phone threatening to cancel just to get it back down.
Everyone hates that.
Everyone hates that. Croney is killing that dynamic. He's got 4 nationwide speed tiers, all in, pricing modem included, unlimited data, and he's locking that price in until 2031.
2031. Wow. That is a lifetime in the tech world.
It's a defensive moat, He knows if your bill is flat for 5 years, you're much less likely to jump to T-Mobile just to save $10 a month.
Yeah.
He's trading the ability to hike prices for the ability to keep you as a customer.
He's accepting that ARPU won't grow much in exchange for lifetime value.
Exactly. Lifetime value. That's the key phrase.
Speaking of lifetime value, this brings us to the most aggressive and maybe the most desperate part of the strategy, the free line tactic. This is where I started to get a little skeptical.
Ah, yes, the buy one, get one strategy for your digital life.
They are offering a free mobile line for a full 12 months to broadband customers.
Yeah.
A year of free service. And the numbers show it's working. 50% of their residential connections in Q4 were these free lines. But are these real customers? Or just people grabbing a free SIM card because, hey, why not?
That is the multi-billion-dollar question, isn't it? Management claims they expect a meaningful portion of these lines to convert to paid customers in the second half of 2026. This is the big gamble.
It's all based on this theory of convergence.
The idea that if I get my internet and my phone from the same company, I'm sticky, it creates inertia. It's much harder to cancel your internet if it also kills your phone line. They're building a defensive wall out of free SIM cards.
So if it works...
If it works, they transition from a hated cable company to an essential connectivity platform. If it fails, they just gave away millions in revenue for absolutely nothing.
And they are backing this up with real infrastructure upgrades, too. They mentioned something called mid-split spectrum. For listeners who aren't network engineers, what does that even mean?
It matters because of how we use the internet now. Traditional cable was built for downloading, watching Netflix. It wasn't built for uploading Zoom calls, Twitch streaming, backing up your phone.
Right.
Mid-split reconfigures the network to drastically increase those upload speeds. They said 60% of their footprint is now upgraded. It's their answer to fiber, which has always had that symmetrical speed advantage.
So they're saying we can do that too.
Correct. And here's the kicker for the financials. They noted that trouble calls are down 20% because of this. And AI automation. That's huge for margins. Every time a truck doesn't have to roll to a house, Comcast saves, about $150? That goes straight to the bottom line.
Okay, so that's the defensive war in connectivity. Let's pivot to the victory parade. Because while broadband is slogging it out, the content and experiences division is absolutely crushing it. Theme parks revenue up almost 22% to nearly $3 billion.
And EBITDA crossed $1 billion for the quarter. That's a huge psychological barrier they just smashed through. For a long time, parks were the side hustle. Now they're a primary engine.
And this is the part that blows my mind. This is before Epic Universe is even fully scaled, right?
That's the key context. Epic Universe is the massive new park opening in Orlando. Just the anticipation of it is driving behavior. People are booking longer trips, staying at Universal hotels, and spending more per person. We call it per caps.
It's the Harry Potter effect all over again, but on steroids.
It is. They're creating a multi-day destination where you are completely trapped in their ecosystem. It's a cash printing machine.
And speaking of printing money, the studios division, Wicked, was a monster.
The Green Wave. Over $1 billion worldwide. That's a massive win, and it validates their whole franchise strategy. When a movie hits like that, it just cascades down the company.
It goes to streaming on Peacock.
Becomes a ride at the theme park, sells toys. It's the synergy they always promise, but, rarely deliver.
Which brings us to Peacock. The numbers, they look good on the surface. Revenue up 20%, 3 million new paid subs. They're at 44 million total now. But the losses got worse.
Yeah, the adjusted EBITDA loss widened to $552 million.
Why? If they're adding subs and revenue is up, why is the hole getting deeper?
2 words. Sports rights. This is the cost of doing business in the big leagues. They're absorbing the costs of the new NBA deal, the NFL rights. This is an investment year for sports. They are betting that live sports is the only anchor left that keeps people paying.
And they're doubling down on that immediately. They kept talking about legendary February.
It's a massive catalyst. Think about the ad inventory here. You have the Super Bowl, you have the Winter Olympics in Milan, and you have the NBA All-Star Game, all hitting NBC and Peacock in the same 30-day window.
An advertiser's dream, but an accountant's nightmare in the short term?
Precisely. It's incredibly expensive to produce the Olympics, but the strategy is acquisition. The hope is millions of people sign up for Peacock to watch the downhill skiing, and then they just forget to cancel.
Right, or they stay for the office.
Exactly.
Let's zoom out to the corporate structure, the Versant spinoff. That was completed back on January 2nd.
And thank goodness, Versant took all those cable networks, MSNBC, CNBC, USA, and spun them out. Investors call these melting ice cube assets. They still make a lot of money, but they're shrinking as cable TV dies.
So it cleans up the story.
Makes the investment thesis much cleaner. Now, if you buy CMCSA, you're buying connectivity, studios, parks, and streaming, not the declining linear channels.
But management was also brutally honest about the near future. They basically told Wall Street, do not expect growth in 2026.
Honesty is the best policy when you need to reset expectations. The CFO was clear. Adjusted EBITDA was down 10% this quarter because of these investments. And for 2026, no broadband price increases.
So if you aren't raising prices and you aren't adding many new users,
your revenue stays flat or dips. They are explicitly telling analysts not to expect material broadband growth until 2027. They're taking a gap year.
Which requires a level of patience Wall Street is famously bad at.
It does. But look at the capital allocation. They returned $2.7 billion to shareholders this quarter alone. $1.5 billion of that was buybacks.
So they are paying us to wait.
That's it, exactly. They're saying, look, we know 2026 is a transition. Here's a solid dividend. Here's a massive buyback to support the price while we fix the engine.
So if I'm an investor, why bother with a company that says we aren't growing for 2 years?
Because of the pivot. The market has fundamentally shifted from price-led growth to a promo-heavy battle. Comcast is trading near-term margins for lifetime value.
That's the buzzword we keep hearing.
It's the math. If I give you a free mobile line, I lose revenue today. But if that makes you stay with me for 5 years instead of 2, the total amount I get from you is much higher. The market's reaction suggests investors are willing to give them a hall pass for 2026 to execute this.
As long as the cash machine keeps printing.
As long as that $4 billion cash machine keeps printing, and the catalyst to watch is the conversion rate.
100%.
Yeah.
Late 2026. When those free mobile lines hit their 1-year anniversary and the bill comes due, do those customers stay and pay, or do they cancel?
If they churn, the whole thesis breaks.
Okay, that brings us to my favorite part of the show. We've looked at the past, we've analyzed the present. Now let's get a little crazy about the future.
All right, standard disclaimer time. What we're about to discuss is for entertainment and educational purposes only. This is not financial advice. We're just two people with microphones and a spreadsheet. Do your own diligence.
Absolutely. But imagine we're in a hedge fund strategy meeting. You got the data. The market is pricing in a dead year for 2026. I have a trade idea that exploits that pessimism. I call it the epic convergence leap.
I like it. Sounds dramatic. Lay it out.
So here's the setup. Everyone is bearish on broadband for the first half of 2026. Management just told us no price hikes, margins are compressing, they're giving away mobile lines for free. The consensus is dead money.
Right. Why buy now when the good news is a year away? That's the logical take.
Exactly. But I think they're sandbagging. The trade idea is long-dated call options leap for January 2027.
Interesting. So you are completely bypassing the 2026 reset noise and betting on the exit velocity at the end of the tunnel.
Precisely. Here's the logic. 1, the bar for 2026 broadband revenue is on the floor. It is so low they could trip over it and still beat it.
Okay.
Second, think about the timing. By Q4 2026, you have Epic Universe fully operational, not just opening, scaling. It's going to be printing money during the holiday season.
And that coincides perfectly with the mobile conversion timeline.
That's the third leg of the stool. All those free lines they're handing out right now. They start hitting the billing cycle as paid subscribers in the second half of 2026. Suddenly, you have a massive margin expansion story.
Wow.
You have theme park revenue peaking and mobile revenue turning from zero to hero at the same time.
I see where you're going. You're betting on a margin explosion in Q3 and Q4 2026 that the market is just ignoring because they're fixated on today's broadband losses.
It is an outrageous bet on a legacy cable company actually pulling off a pivot. I mean, if they convert even 30% of those free lines, the margin expansion will shock the street. And options are cheap right now because volatility on the stock is low.
It's a leverage play on execution. If the free line tactic works, the stock re-rates from a boring utility to a growth stock, right as the theme park boosts the bottom line. It's clever.
And if they fail, well, that's why it's a risky trade. If people cancel the lines and broadband keeps shrinking, those options expire worthless. But the upside could be significant if the narrative shifts from dying cable to converged cash machine.
It's definitely a contrarian take. The market hates uncertainty, and you're betting that the uncertainty resolves positively.
That's the pitch. The epic convergence leap. Again, not financial advice, just a scenario to chew on while you're watching the Super Bowl on NBC next month.
Which, purely by coincidence, is part of that legendary February we talked about.
So, to bring this all home, a quarter defined by a massive cash beat that's masking a defensive war in broadband.
Management is asking for patience during a reset year in 2026. The market bought the story today, probably seduced by that $4.3 billion in free cash. But make no mistake, execution on that mobile bundle is now the only thing that matters.
If they can turn free lines into paid subscribers, this stock works. If they can't, the cash machine might start to sputter.
And we will be watching that conversion metric like a hawk.
That is it for this deep dive into Talk Tickers. Be sure to check out the safe harbor statement on the Comcast Investor Relations site if you want the full legal rundown. Stay sharp out there.
Stay curious.